Hello guys, welcome back to lesson 12, and on this lesson we're going to talk about institutional sponsorship, and we're essentially going to go straight into this, and it's going to be a continuation from lesson 11b where we talked about institutional order flow and what it is, and we described that conceptually. So in this lesson we're going to talk about institutional sponsorship, and we're going to define that in context of what algorithmic trading is all about. Alright, so institutional sponsorship is the willingness to protect or defend a price swing that has a high probability of unfolding. Okay, and here obviously I have to type some things down. So these are bullet points that you can copy on your notepad or your journal as you go through the course, and that's why I typically don't like to type things out and read through them, but these are ones that you want to have in your journal because you're really important to your understanding of what institutional sponsorship is. But essentially what institutional sponsorship is the willingness to protect and defend a price swing that has a high probability of unfolding. Alright, so I'm gonna try my best to use a real world example to communicate how institutional sponsorship would look like. Okay, so let me try and come up with something that you guys can all relate to, and I think, all right. So I think we're gonna use this example. I've been using sneakers for since the start of the course. I don't know why I keep using sneakers. So let me switch it up and use Netflix, or because Netflix, yeah. So imagine your Netflix subscription was, let's say, $12. Okay, your Netflix subscription is $12, and new competitors are in the space. Okay, they're in the streaming industry, so competitors are going to be competitors like Hulu, Disney Plus, I think just HBO Max, and then just Amazon Prime. Obviously, these are all competitors in the same industry. So now think back to 3 or 4 years ago when the streaming industry started, and not actually more like 7-8 years ago when the streaming industry started, and it was only Netflix. Okay, then you could like share passwords, and the subscription fee was small. Obviously, it was around, I think, $4 per individual, and then over time with inflation and stuff, it started to increase. Okay, now Netflix is never going to go back to $4, which they started out with. So when I was in university, and I think it was just one time I got an iPhone and I wanted to try to subscribe to Netflix, and it was literally $4, but I had no credit card to make a subscription with, and I could not. There's no way now. I think now it's around like $16 or so, either $13 to $16 right now. It's literally over triple the amount it was a couple years ago. There's no way Netflix is ever going to take back subscription fees to $4. Okay, there's no way it's gonna take back to $4. So I want you to look at that increase in price fees due to inflation and cost of production of the movies and everything. Okay, I want you to look at that increase as institutional sponsorship. Okay, so the same way Netflix will never go back to, and this might be a shitty example, but it's kind of similar to the point I'm trying to bring across. But the same way Netflix is never going to go back to that $4 subscription fee. Okay, that's also what that entails with institutional sponsorship. Meaning, if we have a level where institutions came into the marketplace to sponsor a move, they're going to try to defend that move. Okay, and the defending of the move is what we call institutional sponsorship. All right, now who are the institutions? Remember, retail cannot be institutions. Retail does not have the same amount of liquidity or the volume of transactions that institutions have. So institutions are going to be large speculators in the industry. Okay, these are who we call institutions. Okay, so because we are looking at institutional sponsorship, what we are primarily concerned, and this is the key word here, again, keyword, I'm emphasizing this. What we are primarily concerned is displacement from key higher time frame levels. I'm going to repeat myself one more time so you really fully grasp what I'm describing. Displacement from key higher time frame level indicates institutional sponsorship. Why? Why are we talking about key higher time frame levels? Why is that a concern? Because the lower time frame, all the stories and all the noise in lower time frame, they are the product of higher time frame delivery. Okay. Now remember, we are only riding on the coattails of the relationship between smart money, aka central banks, and institutions. Okay. So this relationship, okay, this mutual relationship between smart money and institutions is what provides liquidity in the marketplace. Right? So institutions, they're going to build in positions. It you're not like you because of the sheer size of your volume. They cannot just go into a lower time frame 1 minute chart and just build in orders there. And just take a trade there with lot sizes. It's just nothing like lot size for these entities. Okay, we're talking about contracts. We're not talking about lot sizes. Okay, retail concerns themselves with lot sizes. These are entities who are dealing in contracts. Okay, so again, they have to build positions off of high time frame level because that's the only way they can allow for efficiency in delivery. And that's why you see prior to down move, you see an order block form. They were selling into the order block, and then price returns back up into order block, and they're reaccumulating more of that position. Why? Because they cannot get in all their position at once. So that's why I see price return to these key levels, because it's providing the institutions a chance to get into a move or building open positions. Okay. And when we see displacement from key higher time frame levels, that indicates that relationship we're looking for, which is a telltale sign of institutional sponsorship. It's in play. Okay. So like Lightworks, where they have a clue. Once we can define where the general liquidity is, aka where the institutions should be exiting their either accumulated longs or accumulated shorts, then we already know we have market direction on our side, we have order flow on our side, and that is validated by displacement away from the higher time frame level, which is what we define as institutional sponsorship. All right, let's talk about institutional sponsorship in bullish scenarios, okay, or bullish executions. The first one we look for is we look for higher time frame displacement, aka reversals from key higher time frame levels, or expansions, or return to fair valuation at key higher time frame levels. That's what we're looking for. And then from that higher time frame level, we're breaking down to an intermediate term, and what we're looking for is intermediate term imbalance in price. Okay, so that means if we want to be bullish and we're looking for bullish setups, then we want to see on an intermediate term time frame. So intermediate term is an intermediary time frame between higher time frame and your time frame of execution. So if your execution is 15-minute time frame as a day trade or 1 hour time frame as a short term trade, then your intermediate term time frame is going to be daily/4 hour time frame as an intermediary time frame. That you break your understanding of higher time frame delivery, and as you translate that into lower time frame narrative, you use that intermediate time frame to identify intermediate draw on liquidity. And what you're looking for is, if you're bullish, you're looking for an intermediate time frame return into discount or sell side liquidity. We're going to talk on this. We're going to use live price action example to discuss this price versus discount or sell side liquidity. And then from that intermediate time frame, we go into a short-term time frame. And what we're looking for on the short-term time frame primarily is we're looking for available short-term buy stops, aka buy sell liquidity, so that if we are long, then we understand there's a very clear draw on liquidity that should have no obstruction. This is what I call low resistance liquidity runs. Okay, so meaning price has to smoothly run up into liquidity because there's a need for that transaction. And I think I did a lesson 2 days ago on how to understand when low resistance liquidity run shifts into high resistance liquidity runs, and that's a very important video. Okay, so if you're watching this right now, let me just quickly take you to that video so you know where it is. Alright, so I want you to go to the commentaries, which I'm not sure I can access, but look for that's 2023 April, and that would be 13th. Okay, so look for the video I made on 13th of April 2023, and that builds upon the concept of the resistance occurrence becoming high resistance occurrence, and that builds upon this. Okay, so when we are looking to be buyers, it's a must to identify a lower time frame liquidity in direction of that intermediate term draw on liquidity. Again, remember, we don't necessarily need to wait for, just like I showed you on the previous example, on the previous lesson, we don't need for price to trade into a monthly or weekly or daily liquidity draw. Okay, we only need that to identify where the higher time frame should be drawn into. Now, in the process of the higher time frame expanding up or down into that drawn liquidity, we can use lower time frame moves to get a sink and get a portion of that move. That's what we're looking for. But we're looking for institutional sponsorship to confirm or validate order flow. See what I'm saying? So they're all intertwined. Institutional order flow and institutional sponsorship, they're intertwined concept. Institutional sponsorship confirms or validates institutional order flow. And then obviously for our execution to be valid, we're looking for time of day influence, aka London Open or New York Open, for our transactions, aka to look for, I keep saying aka, but to look for trades. And we're gonna do same thing for institutional sponsorship in short setups or sells. All right, so what we look for is we'll look for higher time from displacement. We're looking for reversals, expansion, or return to fair valuation, and then from there we translate that into an intermediate term time frame. And what we're looking for is we're looking for price to return up into a premium because we want to be a seller, or a buy sell liquidity run, aka a terror soup. Okay, so if we have a run on a short term high, that's a daily high, we want to see that be a reversal. Okay, we want to see price displace away from there if we are bearish. Okay, that break above that short term high, we should not look at that as a breaking structure if we are bearish. And then we take that to a lower time frame, a short term medium, and what we're looking for is we're looking to confirm the validity of sell side liquidity draw in price. Meaning, if we are bearish from the higher time frame to the intermediate term time frame, can we identify a lower time frame sell side liquidity draw that price should be reaching for, where we can pair short term short exits to buy from. So if we're selling, then obviously when price gets to that sell side liquidity pool, then we're going to close our position, which is going to be a market execution to buy back at a profit or at a discount. That's what we're looking for. And obviously we're looking for time of day influence to confirm our trades, and this is very important for day trades and short-term trades. For swing trades, it's still important, but not as important, because sometimes you can trade carry over sessions. But for short-term trades, which is you're looking at the weekly profile, or day trades, which is you're looking at the daily range, these are extremely important. Time of day influence is very important for day trading and short-term trading, and then time of week influence is very important for short-term trading to swing trading. All right, so let's go into a live price action example, and what I'm going to do is I'm going to use the previous example of euro dollar for this lesson. I think I used forex.com, so we're going to use forex.com for this. Okay, and let me clear up all of this. Let's go back. Okay, let's go back to that higher time frame level, and we're going to use this. All right, there. And we're going to go out to a weekly time frame. So from that weekly time frame, we're going to identify the high, low, and then mean threshold of this hedging program. There's a mitigation block on the weekly time frame. that is here. And that essentially is the main threshold of this high time frame discount. Okay, that's a mitigation block. All right, so we're gonna shift this down to a daily time frame, and you can see already just by looking at price action over the last 6 months, you can see we're obviously bullish. And what I teach is you don't want to try to call tops in the marketplace. Okay, so even though we're calling for the market, I think somewhere around here, we're calling for the rejection blocks down here. Okay, we never said we're bearish. We're only looking at this as a retracement, and that's key. Never ever ever try to call a top in the marketplace. No trader can do that efficiently and for a very considered period of time. Okay, so never try to do that. All right, so what we have is we have sell side liquidity at that weekly main threshold. So we're going to define that daily sell side liquidity pool here, and that's the daily sell side liquidity pool. Now let's go back to the example for long setups. What we're looking for is we're looking for our time frame displacement. So we're looking for reversals, okay, and that has to come at key higher time frame levels because that's where we're going to see essential sponsorship. So what we're looking for is we're looking for dynamic displacement away from these key higher time frame levels. So if I broke this down to an intermediate term time frame, which is a 4 hour time frame, okay, for if I broke this down to a daily time frame, which is an intermediate term time frame, because I'm looking to do executions on the 4 hour time frame, and I went lower. What we are looking for, again, so we're looking for intermediate term balance in price, and we're looking for price to move to discount or sell side liquidity. So if we see price run a short-term low or a daily low in a bullish daily order flow, just by looking at the trend at an higher time from discount, we don't look at that as a breaking structure. Okay, we're not viewing that as a breaking structure. Instead, we're viewing that as smart money is getting down here, reaccumulating longs from retail sell stops, and they're looking to continue the trend and sponsor the trend higher. Now, next up, what we're looking for is we're looking for where short term can we find a place or an area or liquidity pool to pair our longs against, meaning where in price can we find buy stops since we're bullish, because we need that liquidity. We should be a low risk in the current run. We need that liquidity for us to pair our orders, because that's the way the institutions are going to exit or distribute their positions against. So we have one here, meaning as we run lower here, there were entities who were shorting the breakout. Okay, there are entities inside this range who are shorting. If they're shorting or if they're selling and we've neutralized the longs, anyone who was buying inside this range, they're definitely stopped out because of this sudden run in price. Okay, so any entity who was shorting, where are you gonna have your protective stops? Up here. So we have a buy sell liquidity pool. So that becomes strong liquidity. Now we have this number 3 validated. Then what we're looking for is we're looking for time of day influence, okay, for our short-term trade. So let's go into, this is Wednesday, and let's identify our discount, which is this far bullish order block. And what we're looking for is we want to see price expand away from there after the run on sell stops. So we're gonna go down and we're gonna bring out the session or daily dividers, and this is Monday, Tuesday, Wednesday, and this is going to Thursday, and we're looking for London or New York session. So at any time during London or New York, if we trade down there, then we have a trade. Just gonna use the replay tool, and let's see if we trade down there. Okay, we're displacing away from there. Okay, so this is the start of New York session here. Starts New York session. We're trade down into our discount. This black line there, remember, that's the weekly high time from discount. Okay, what you can see here is you can see displacement after a run on sell stop. This indicates institutional sponsorship. Now if you're buying from here, Okay, that 4-hour discount you've identified, and your stop is below there. Again, your short-term trading, meaning you can hold for several days, and you're aiming for this. What are you looking for? You're looking for aggressive run higher. Remember, the best trades oftentimes will come after the run and stops. That's when you're going to see the most dynamic price movements in price. If you're bullish and price runs a short-term low, that's the best time to be a buyer. If you're bearish and price runs a short-term high, that's the best time to be a seller, because you're getting Tertiums are the most discount prices you can ever get in price. Okay, before anyone else's attention is even drawn into that asset, you're already in the move. While everyone else is chasing the displacement, you're already in the move before displacement occurs. That's what Tertium does. So now let's follow through and see the outcome of our trade. Okay, so looking for a dynamic displacement away from our execution, and you're seeing this on institutional sponsorship. Okay, the moment you see displacement away from here that it return back down into discount, that's institutional sponsorship, because it's displacement away from an high time frame level. That shows that we have support. So this return back down there, remember the logic I gave you guys. The institutions cannot efficiently get into a move, so they have to do so gradually. So when price runs below short-term low, they're buying against sell stops, and as price displaces and then returns back down there, they're buying again while everyone else is chasing the sells. While everyone else is trying to short, they're buying, and as you're buying, they need a counterpart of liquidity to pair their buy orders against, because they need someone else to sell to. Who are they going to sell to? They need buy-sell liquidity from a retail or funds or shorting, or we're shorting inside the string. So while everyone else is still not convinced of the buy, you're looking at this as resistance and resistance and resistance, and you're using all the Fibonacci's, and you're looking at this as a breaking structure. The funds, the algo will drive the market up here to allow the funds exit a portion of their move. So watch this. And price returns back down to discount, which is a bullish order block. Oh, sorry, see displacement, and all right, so 1, 2, 3. And finally, I think 3 days after, we finally see our move come to fruition, and we called this portion of the move, and we called the trade on this portion of the move on this day. I think I've clearly remembered this. We participated in this move higher. You can see that is how you get into moves before anyone else is even participating in those moves. This is institutional sponsorship, guys. Okay, so just to wrap up the video, when you're looking for institutional sponsorship, you're looking for institutional sponsorship from key high time frame levels, because these are where the relationship between the banks and aka smart money and institutions are evident, and you can understand the delivering price. And the lower time frame gyrations will always stem from high time frame price deliveries, and that's why high time frame price deliveries are very important to your analysis as on any discipline of trading. If you're day trading, scalping, short-term trading, high time frame analysis is really important, because if you don't know where price is going to on a high time frame, essentially you're going into lower time frames blind. Now that does not mean you need to know every drawn liquidity every single day to trade scalps. Obviously you can trade short-term draws on liquidity on scalps, and the same concept I teach obviously applies to lower time frames, but we're going to get into the lower time frame module. But this is how you can validate institutional order flow by identifying very fast and lethargic displacement from key high time frame levels. Okay, with that being said, we're going to wrap up the video here, and I'll catch you guys all on lesson 13. Trade safe.